Welcome to our State of the Industry. We'll hold for just a moment while Zoom loads all the attendees in, and then have a few quick AAPL announcements before we get into the webinar today. Thank you all for joining us today. We do have a few quick AAPL announcements before we jump into the subject of the webinar. So first, for many of you who are should all be members on this webinar here today. So if you're not, you're being really sneaky right now. But we did want to make sure that we were reinforcing all of the wonderful benefits that we had for you as members. So we do have some of the biggest benefits we offer among the education, ethics, and advocacy. We have the industry's only publicly accessible complaint process, where we protect both borrowers and our membership with our code of ethics and our investigation process to make sure that everyone's not only following our code of ethics, but that we're also protecting our members from people who seek to use our complaint process as like a Google review type thing. So we do take it very seriously, and we do monitor it very closely. The other thing that we are really happy to be able to continue to share with our membership is that we continue to be very strong in legislative advocacy. Every single battle that we have ever entered to protect private lender interests across the country, both in state and federal legislators, we have won. We have come out ahead. So we're very careful about the battles that we choose to enter, and we do have a wonderful track record there in now over 20 different legislative issues that we've personally handled. And Nema has probably that fight many times with us. So we're so happy to be able to partner with Gerasi, our general counsel, to make sure that we are protecting your interests in both state and federal legislatures. So the other more educational offerings that we have are very wide ranging. This webinar, of course, being one of them, and the state of the industry being one of them. We also offer both in-person and virtual roundtables, a quarterly print magazine that you should all be receiving as members, and please let us know if you're not. An online vendor guide, and then our member toolbox being some of the biggest ones that we have to offer for you. And then, of course, for the promotional aspects and representing the industry, we have our member directory and our member emblem. One of the more unsung things with our member emblem is that it does protect our members, and we do verify membership and get numerous calls and emails on a daily and weekly basis verifying that from borrowers that they are actually working with you as a member. So they do find that important, and we do field many of those requests. So make sure you're displaying that, because we're happy to verify membership and add that credibility to what you're doing in the industry. So if you don't already know this already, you are living under a rock, but November 12th through 13th this year, we are meeting for the 14th annual conference in Las Vegas, still at Caesars Palace every single year. So heads up, as many of you already know, we do have Formula One happening shortly after our conference this year. So we are wanting to make sure that you are aware that travel is going to be an issue in and around the Strip. So we do suggest that you stay at nearby hotels and go ahead and book those hotels if you haven't already. Unfortunately, our room block is completely sold out. We more than doubled our room nights that we normally have for our annual conference, but we are all closed for those now. So go ahead and register for the conference. Make sure you're booking your room. And if you have any questions, head over to aaplconference.com or reach out to the team at contact@aaplonline.com. If you're looking for additional education opportunities, we do offer 2 online courses. Our Certified Fund Manager course and our Certified Private Lender Associate course are now available online. They are members only, of course, and they are $349 each. You can find out more information about them at aaplonline.com/courses, or of course, reach out to the AAPL team at contact@aaplonline.com. Quick housekeeping today. For our State of the Industries, these recordings the live broadcast is available to members only. That's you all here today. And then they are released to both members and public 2 weeks after our State of the Industry. So that will be October 31st. We don't release them for members ahead of that. So stay tuned if you want to do any replays or want to share them with your team. They'll be posted online in our webinar archive at aaplonline.com/video. As you're navigating the webinar today, you can use the Ask a Question feature to add it into the queue. We do ask that you use that instead of chat because it's much easier for our panelists to follow and make sure that they're answering those questions for you. And then post-webinar, if you do want to get in contact with anyone, we're more than happy to connect you and pass your questions along. Reach out, of course, to contact@aaplonline.com. And now, passing things over to Nema, our host for our State of the Industries. He'll be taking things over from here. Thank you so much, Nema. You are muted.
It has to happen at least once. All right, appreciate that, Kat. Thank you for everything that you do over for the industry. The team at AAPL is constantly working on behalf of its members and greatly appreciate those efforts. I am super excited about today's State of the Industry. This will likely be the last one that we will do for this year, and we're going to definitely be ending on a high note. I've got my esteemed guest here with me, Arvind with Kiavi, formerly known as LendingHome. I am very excited about catching up with him and things and hearing about your viewpoints on the market as being the largest private lender in the country, and really getting an understanding of how you view the market. Before we get into that Q&A session, I'm going to present a little bit of data from the Lightning Doc side of the house. For those of you who have not attended previous webinars before, Lightning Docs is our loan document platform that is geared towards private lenders. They are the official loan documents of American Association of Private Lenders. And the data that is represented here is the underlying data from the users of the system. So we aggregate the information and try to send it back out to the industry, hopefully add a little bit of value out in the marketplace. So without further ado, I'll go ahead and start going through some of the data and the insights. So big picture, the system currently, as it exists today, generates a little over $1 billion a month in $1 billion a month in monthly transactions, and a little over 2,000 loans per month currently. And we're going to be taking a look back at January 1 of this year and kind of following the trends as they've occurred throughout the year. So the first thing that we're going to see is tracking from January through September on the bridge loan volume size. When I use the term bridge, I'm just simply meaning short-term financing. It could be, a true bridge with no construction. It could be a ground-up construction. It could have construction. So any sort of short-term duration, and short-term duration for me is 36 months or less, interest-only product, fix and flip, whatever. So that's what I'm tracking here when we are separating out the data, because we have both that sort of short-term product as well as the 30-year term DSCR product. And so obviously those two are very different, and I wouldn't want to merge that data when presenting it. So when we're looking at the volumes, one other thing to note when we're looking at the slides presented here, when I'm tracking the volumes, I have to track the same users for a period of time. So in this context, I am tracking the same users that they must have been a user as of January 1, 2023. So if someone signed up to use the system on January 2 or afterwards, they are excluded from this data set because I want to get an understanding of how the same exact market participants, how they are transacting over a period of time. So when you look at the underlying data here, we had some scary months for those of you who have been around. This is no surprise. Kind of in the tail end of December of last year and going into January, February, it was pretty slow from an activity perspective. And we had a significant increase in the month of March. And it's kind of been Groundhog's Day from that point forward. So we're seeing a little bit of increase in activity, maybe about 10% or so. We had pretty significant volumes in August, right? We had 1,200 transactions over those same users. But from March through September, we're kind of seeing this float with a slight increase, about 10% from March to September. But when you actually track it from that low point back in February, you're seeing that 60% increase. So definitely a good increase from that point. And then when, people who want to know kind of what are you seeing from the previous peak, which was, back in March of 2022, we're still down about 20-25% from that point. So, obviously this year is going to shape out to be worse than last year. But I think all things being equal, there's a sentiment of this ended up better than I was expecting when we're polling our clients and the users. So, businesses are still operating and continuing to flow. Next slide over here is, I try to smooth out the data a little bit. Sometimes it's hard to track month over month. So I look at quarter over quarter. I don't really love quarter over quarter for bridge because I think it really does, when you look back at that previous slide, we had March, which had, significant 44% increase. And so that's necessarily rolled into the Q1 data, when in reality, Q1 probably felt mostly like January, February for most people, and you would have a massive increase from that point forward, and then kind of a stagnation that has sat after that. But, still big increases for the year here from quarter over quarter when you smooth it out, around 40%. Another thing we track here is both the interest rates that we are seeing on this product, as well as the average loan amount. For purposes of looking at these, I exclude loans in excess of $2 million to try to remove any sort of really, really large loans. And I similarly eliminate any interest rate above 15% because I think that's kind of the anomaly. So we stick with loans less than that percentage and those amounts. And then here's what you're seeing here. And I similarly exclude any data that's below $50,000 as that's typically out of market as well. So as you see here, the average loan amount nationally is, just a touch over $400,000 typically. When we're looking at September of this year, we're hovering at just a little under 11.3% nationally. As with all things, when you're presenting interest rate and loan amount data, at the end of the day, this is really MSA driven, particularly in the bridge product, and you'll see huge volatility both in loan amounts as well as interest rates when you start looking down to the county level. One of the things that you'll see an article, for those of you that subscribe to any of our material, I just highlighted Atlanta as an example of this, where just in the city of Atlanta, for those that do not know, traverses two separate counties. Just in the city of Atlanta, you will see 100 basis point spread between the two counties in Atlanta, which shows you how local interest rates are and can be as it pertains to this market. You'll see a lot less of that in the term rental product, but it is very local, both in interest rate and amounts. Going into just smoothing that out again, kind of by quarters, you're really seeing not a ton of volatility occurring in interest rates or loan amounts as it relates to the bridge product. We're seeing slight changes here, but again, at the local level, you'll see a lot more movement. This one I found particularly interesting, and I think is probably the most common question, which is, great, I've just given you an 11.3% average national amount. Well, what makes up that pie? And what you're actually seeing is really broad diversification. So this slide has a lot of content, and I'll try to break it down as simplistically as possible. When you're seeing here in that 3% slice as an example, you are seeing a rate of less than 10%. What that means to me is anything from 4% in this example up to 9.9999%. That's what you're seeing reflected here. In that 18% slice where it says 10%, that means the interest rate in that loan transaction starts with a 10. It could be 10.0. It could go all the way up to 10.99. That's what the segmentation here is that you're viewing. So what you're seeing is pretty broad. Lenders are really lending it at a variety of rates. There's 18% at something around 10%, 36% at some in the 11s, 29% in the 12s, and 14% greater than 13. One thing that I get a lot of feedback on, and oftentimes directed to my dear friend Arvind, which is, Kiavi keeps undercutting me. They keep, they're at 9s, and how do I get a 9? How can lend at 9? And the reality I always tell people is that you may have isolated incidences in which people are below 10% at this juncture. It is the anomaly, and it is probably a customer acquisition game or something like that, or trying to go after a highly valued customer relationship. And so that is not where the market is. What you're seeing here is really much more indicia of what to expect in the current interest rate environment. In terms of volume, so where are people transacting? California, Florida, and Texas have remained the top 3 states in that exact orientation in 2022 and in 2023 so far. On the right-hand column here, I'm listing interest rates by state. And again, I wouldn't bank on that just because it says California. You're going to see a pretty wide variety. When you go to the densely populated areas, such as Los Angeles County, it's going to be lower than this. I think it's closer to about 10.7%. Versus Fresno, you're going to probably see closer to 11.8, 11.9. So it really does depend. Riverside and San Bernardino, these other counties that are more sparsely populated and tend to be more tertiary will have a higher yield, but obviously your coastal California, your Los Angeles, Orange County, San Diego are going to be tighter markets to lend in. And you'll see that, I'm sure, in any one of these states. When you look at the kind of movements in volume, New Jersey is kind of the biggest increase or entrant here, which is very interesting to me in the sense that it is lower than our national averages at 10.8%, and also sits as one of the longest judicial foreclosure states in the country. So I've never been able to reconcile why you all do this, but nonetheless, you shouldn't. But if you're going to factor in a loan out there, there's better be a yield reasoning behind it. But nonetheless, you're choosing to lend at lower rates and take on longer duration foreclosure risk. But that is the game in New Jersey. And you're seeing a little bit of movement kind of all throughout here as well. Ohio rounding it out at the bottom in 10th place. Going on to the next slide here is that now I'm tracking, instead of that short-term product, I am tracking the rental loan volume. So this is the 30-year DSCR product specifically, because we don't have any other users in this system other than private lenders. So this is not, looking at any sort of other types of operators. So here, rental, the story looks similar to the bridge, meaning that you had kind of a pretty scary situation in January, February. That got much better in the month of March, and that one's going to be trending along a little bit better. So from 640 to 770, that's a little bit more than a 10% increase from March to September. And similarly, August was the best month for the users there so far, and September looked much more like July than it did August. Tracking into the volumes by quarter, kind of seeing that smoothing out as well. And we're seeing a 51% increase from Q1 to Q3, roughly, around 400 additional loans per month were being generated in each quarter. And now we're looking at the underlying average loan amount, and using those exact same parameters as well that I previously provided from the bridge, which is nothing in excess of $2 million and nothing less than 4%, nothing above 15% on the interest rates. Looking at the underlying data that's here, is you're seeing much more volatility on the 30-year product, which makes sense. This product is going to often still is securitized, and because of the duration, it really does need to match current pricing. So this is much more current market environment contingent. So whatever the treasuries are, whatever consumer mortgage lending market looks like, and you're seeing it currently at around 8.3% from a national basis. What is very interesting here and is looking at this, this is just the quarter, so kind of same example here, but what I found fascinating when I looked at this information earlier was that there's actually a lot of 9% that's occurring. So even though we're seeing that average of 8.2, close to 8.3%, a lot of loans are being written. 44% of them are written in nines. And so we are seeing a pretty big spread right now between originators as it existed, at least in the month of September, which was very interesting to see in the underlying data. When we're looking at rental states, if you notice, California doesn't exist. It's very hard to get a DSCR that pencils in the state of California. So different states will populate here. Texas is a big market, Florida's a big market, and other markets that you'll see here as well that are all performing fairly well, which makes sense. These are states in which you can actually make a 30-year term pencil, and you're seeing the movements that are occurring within those. Ohio is making the biggest movement up, from 10th place to 5th place, as real estate investors are trying to figure out ways to make these deals still pencil. So you've got to be in markets in which that can make sense. All right, and that is the end of the data side of what we're doing here. I'll go ahead and stop sharing my screen so we can get our fine faces here. All right. And so without further ado, like I said, I'm very excited to have Arvind on here. Kiavi, for those that do not know, is the nation's largest private lender. They are a market dominant force in basically every market that they choose to participate in. And they are, generally speaking, the number one originator in any market that they choose to play in. They are a formidable force in the market. And so for those that don't know about kind of you, Arvind, and Kiavi as well, can you just give us, a quick highlight of you and the company?
Yeah, sure, Nema. Thanks for number one having me on the webinar, and appreciate the kind words. It's not just one, right? It's a team effort. I think we've built a pretty an exceptional business here serving real estate investors, and it's kind of a whole team effort, and I'm excited to continue to support them through this market. As a background, Kiavi is essentially a tech-enabled lender to real estate investors. We're primarily a lender across the fix and flip kind of bridge product side, as well as on the rental DSCR front. And then, we've also recently added a rental portfolio product to continue to expand our product suite across, just kind of more offerings for real estate investors. We're primarily a direct lender, although we've made significant investments in expanding our broker channel over the last couple of years. And so that's kind of grown from being about, I don't call it 5 to 10% of our business to closer to like 15 to 20%. And we continue to make efforts there to continue to broaden our acquisition channels. As Nema mentioned, we consider ourselves the largest lender in the space, especially on the kind of fix and flip and bridge front. We'll probably do over 4 billion of origination overall this year, and come in, not too bad versus last year, where we did about 4.5 billion between the kind of fix and flip bridge product and the rental DSCR product.
Right.
Go ahead.
No, please. No, go ahead. Sorry.
No, look, I think the only thing to add, right, for us, we're looking to differentiate ourselves in terms of how we are looking to drive scalability in ourselves, as well as from a customer perspective, and ensure that we can scale the customer experience of the offering and really be able to provide competitive terms. It's not just about price, right? It's leverage matters in this space, and return hurdles matter for investors. And we see ourselves as a partner to them, right? To whether they're a new investor or someone that's experienced and seasoned, we want to combine your expertise with our data sets and our expertise so that we can ensure a successful outcome.
And one of the interesting things about you is I had the benefit of getting to meet you in person a few weeks ago, and we met in your office with my partner Kevin. And oftentimes in private lender organizations, the CEO oftentimes has primarily a sales background, or is really originations driven, but your previous role in the organization was COO, right? So
yeah.
And so you're really coming at this from an operator's perspective and really understanding the operational side of it. So actually give me a little bit of background about what were you doing in Kiavi before being named CEO?
Sure. Yeah. So for everyone that hasn't met me, right, I'm Arvind Mohan. I'm the CEO here at Kiavi. So I've been in the CEO role about call it like nine months now or so. And prior to that, I was the COO of the company for about 2.5 years, where I did oversee like a kind of a large part of the organization, including sales and operations, as well as capital and credit. Prior to COO, I've been with Kiavi for about 7.5 years now. And so prior to the COO role, I was primarily in the capital markets and credit side of the business, kind of overseeing those teams. So my background, right, even before Kiavi, has been much more on the capital side, but kind of focused on the mortgage asset class and mortgage finance and structured products. I was at Barclays for about 10.5 years, where everything from kind of pre-crisis to the crisis, the financial crisis, as well as post-crisis, and thinking through like non-QM and kind of new product growth coming out of the financial crisis is kind of how I grew up before Kiavi.
And so that's a really interesting background, right? If I understand correctly, is you were at the mortgage trading desk over at Barclays, and so you obviously understand the capital markets side of RMBS and how that transacts. And then obviously kind of worked within Kiavi in various functions, and the last one previous was COO. So coming at it from an operations background of a mortgage originator and all the headaches that come with kind of operating a mortgage origination company. And so you really got this marriage effectively of both mortgage operations with capital markets and capital supply. How has that shaped you?
I think it's been a really interesting background, especially in this market. Like, what I find exciting about the private lending market, that it's effectively the I would say like real estate in general is a pretty big market in the US. But within that, the private lending market is interesting because it is kind of a green space. You don't have the level of commoditization you have in the kind of consumer product, even within the DSCR product, right? It's very hard for folks to like sometimes do things in the DSCR part that makes sense for the customer because, right, they give the rating agencies and you have investors and people have been conditioned to a certain level of lending. Whereas when you take the fix and flip asset class or even the bridge lending asset class as a whole, to me, it's just a kind of a more of a raw opportunity to really shape capital markets and how investors perceive this product through the lens of the real estate investor, right? Ultimately, that's the person that's looking to benefit. And I think what I've been able to do and the company has been able to do is really kind of translate that story from a customer first lens into an institutional credit box and institutional capital story. So we can kind of both drive customer experience and the right kind of competitive terms and pricing that they need to succeed, but also give investors the right kind of compliance framework, origination framework, and risk adjusted return so that they can continue to feed that engine and growth.
Right, because you can simultaneously wear two different hats, right? Which is you can understand what the capital markets expectation is going to be or what they are going to look for ultimately. And at the same time, try to educate any sort of capital partner on that side of it. Hey, here's the reality of a fix and flip product. You can't bring your typical RMBS hat and walk into my shop and expect us to perform in a similar capacity. These are apples and oranges. Do not try, this is not just a variant of a different apple.
No, exactly. Yeah, look, it's a little bit of learning curve for me when I joined, right? Because, like prior to Kiavi, I was never in the private lending space, much more in your consumer non-QM type world. And I think a lot of investors come at the space from a non-QM angle, but it's a little bit of a different beast, right? Like there's value creation happening. It's like a transitionary product. It's only 6 to 10 months or 11 months or 12 months, right? And the loan pays off. And so the risk frameworks are very different. And it's been an opportunity for me to kind of think through that from an operational execution perspective, but also kind of translate that from an investor expectation setting perspective. A lot of education, right? It's been a lot of education, but it's paid off for us, right? I think not only have we been able to educate the investors and build our programs on the investor side, but we've been able to follow through on the performance and the growth and the trust. And so it's a two-way street, and we're looking to like meet that two-way street.
Right. And so, one thing that I think Kiavi kind of prides itself at is this tech-enabled concept. So like explain, in simple terms for our audience, what does tech-enabled mean to you?
Yeah, sure. It's really, I would say in my mind, a couple of things, right? One is, how's the customer served, right? We have kind of a digital first approach to the space, which basically means, right, we don't have paper forms or like, people don't go to a website and fill a form to a salesperson, right? They can actually apply through an origination funnel. We pride ourselves on being able to like provide visibility into pricing and loan terms for our customers. So you can go to our calculator, figure out exactly what the deal is, and then make sure it makes sense. And we're investing more and more in thinking through how do we give more certainty up front, right? But that's at the gist of how we're thinking about kind of serving the customer. And then from, I would say, like an operator perspective, a lot of things we invest in are more on the data dimension, right? Thinking through how do we use the information advantage we have in the space. And we've built up, frankly, organically over the last few years to ensure that we can kind of deliver a very scalable experience from a process perspective, right? Like I still see the private lending market very much as a hyper local market, right? To your point, things matter from like zip code to zip code almost. And for us, it's, how do we use the power of information and data to really deliver like a local market experience at kind of like a, I would say, more global US kind of scale, right? Essentially. And that's where, a lot of the technology and data comes in. It's really running through the different permutations of customers and projects and properties and markets, right? And making sure that you can provide that consistent experience to the customer across these scenarios, and you can kind of really scale that.
So, it's interesting is what I heard from you in that context on the, kind of the front end, the borrower facing side, right? So certainty of execution of the, let me try to get, based on your parameters, here's what I think I can offer you, right? That sort of thing. And it really reminds me of the efficiency of the conventional mortgage market from a technology perspective, right? Is what they're kind of all headed towards. But you're trying to bring that level of efficiency into this very, anachronistic old world of let me ingest this information, then I'll talk to you later about it. So is that kind of your frame? Or, I mean, what was the motivation for even kind of thinking of that? So, that customer experience, that borrower experience?
Look, I think ultimately the customer is the one we're here to serve, right? And I think it's important that, look, I think this is a market where I would say speed to certainty matters quite a bit because,
Yeah.
whether like your customer's working with a wholesaler or has a live deal in the market, like they want to be able to make that decision. And typically they might be even weighing like 3 or 4 decisions, right? Trying to understand, okay, which one should I really do if I can only do 1 or 2. And so for us, it's about trying to constantly deliver that confidence and kind of pull through on the reliability side to say, look, you can be confident that here are the terms and pricing, and what we are going to pull through, right? Like I think we're proud that we lent through COVID. We've been a consistent lender through this entire cycle over the last 18 months, even when it's been a tough, challenging market from a capital perspective. And so a lot of that is kind of really important for the customer, right? Ultimately, for the real estate investor to like come to you as a true partner and understand that you will be there through different times. But importantly, provide that level of certainty that's important for them to grow their business.
And the other fascinating thing is, you've talked about data, but I think we're just really scraping the surface on this, right? Which is, you talked about 2 things: one, data, and that real estate is local, right? And so it's really merging these 2 concepts and sitting and understanding and analyzing your data. How, you're a borrower, why does this matter to them? What is the experience? And how are you actually using this to their advantage?
Sure. Look, it's really a question of how can we provide the best terms and scalability for customers for the opportunities that makes the most sense, right? I think it's I'd say one is obviously the speed aspect where we talked about like how do we deliver the translation of the information the customer is providing us back to them with like loan terms and capital terms, and how do we do that at very competitive pricing, right? But the second is really like how we think about say promoting scalability in the customer's own business model through like whether it's better leverage or understanding I would say from an opportunity perspective, like these types of properties are less risky opportunities, and we're here to support you on those risky opportunities, not by just telling you it's less risky, but we probably give like the highest leverage in the industry, right? And we don't do it just because we can put a number on a piece of paper. We do it because we have the information to understand that, okay, like this is truly less risky, and we should be supporting scalability for the customer in these projects, right?
Right, because your data supports the taking on additional leverage in these certain markets, or the certain the fact patterns being presented, and so it's not there's less discretion being applied in the business, and much more just let the data speak for itself and making the risk decision.
Exactly. And look, I think we're able to advise people too, right? I think we have had customers that come back and said, yep, you told me how to do that deal, but I did it anyway with a different lender and it was not as pretty, right? And so, look, I think we're not forcing people to do anything, right? But I think we're trying to directionally give them information with that capital backing and that certainty of that capital. And ultimately, it's up to them to make the decision, right? I think one of the advantages in this space, and I always think of this versus the iBuyer space, because we had a lot of questions about iBuyers like 2 years ago, is, I'm not here picking properties, right? The customer is coming to us with an opportunity set in their local market, right? And they're smart about their local market, and we're supplementing that information and acting as a true partner to validate it and advise them based on that and make a connection happen.
So that's fascinating, because one thing you just said there was you're also using the data to tell them you shouldn't do this. This is not going to pencil well for you. Is that what I'm hearing that correctly?
Well, we try to advise it through like how we think about leverage and terms, right? And say,
right.
We think this is riskier, and these things have different kind of risk profiles, and so we from our perspective you can go ahead and do it, but we see a higher propensity of risk here, so we'll have to be more conservative in how we lend, right? So we try to
feel free to obtain higher leverage, but at the end of the day, like we don't think that this is going to pencil out for you. We don't think it's going to work for you, and there's too little bit of a margin in here, and so we think the likelihood of a bad transaction is about to occur. Interesting. Fascinating.
Yeah. And look, and I think we're trying to figure out like how, look, I think everything has growing pains, right? I think it's, everybody is used to like, I don't know, 85% LTC or whatever it is, and 90% LTC. And so it's kind of like a conversation with customers to say, look, I think that we're looking for this in the long run for your benefit, right?
Yeah.
And for us, it's really important. The way we've also grown and scaled the business a little bit is around like focusing on repeat business, right? Like 80% of our production is from repeat customers every month, and we're proud of that, right? And so we're looking for our customers to be successful, so they come back and do more business with us and scale their own little real estate investment businesses.
That's right. And so kind of pivoting over to today's market environment, right? So I mean, it's obviously a really interesting time, and for many of our clients, a very challenging time to be in the market. And so really wanted to get your take, from your seat, how you view the market. So the first thing here is just give me from Kiavi's perspective the macroeconomic environment.
Yeah, look, it's definitely challenging. I think it's equally challenging for us as it is for a lot of folks. I think, our benefit has been, we've come in better position from a capital and funding model perspective, as well as our scale and geographic and customer footprint, right? I think we have, call it, almost like 4,500 customers in our servicing book. And so the variety of customers we service across the variety of markets we service in, I think we're in about 32 states in DC. Has helped, buffer, I would say, disparate market impacts, as well as the fact that we've kind of built a very reliable and rigorous funding model behind us, has allowed us to continue to kind of drip that capital to investors, right? Obviously, from a credit perspective and liquidity perspective, we are also seeing the liquidity challenge in the market, the higher cost of capital, as well as from a credit perspective, right? More uncertainty means you got to be more conservative.
Yeah.
And so those things definitely have impacted how we have viewed our lending terms mostly.
Right.
But
which one do you feel has the more substantial impact to you? Is it the reduction in leverage, or is it just the cost of capital? Which one do you feel has been the harder pill to swallow for the investors?
Yeah, I think for investors, it's really, I think we've tried to actually stay pretty consistent on leverage overall.
Yeah.
Look, I think cost of capital has gone up, and I think investors absorb it quite okay. I think when people are targeting 25-30% returns, right, like a half a point or a point change, they're able to price it in. I think what we're seeing is investors adapted to the new environment pretty quickly and rapidly in our book.
Right.
I think you saw a transition happen in H2 of last year. But then, we are very rigorous, right, in terms of thinking through exit valuations relative to how we thought values would play out and so forth. I'm seeing a lot of normalizations that actually showing us the investors have reset their buy boxes, right, for the current market. I think what I see as the main challenge, I think this is for us, but also for investors, is housing velocity in general. Right, days on market is longer. It's deals are harder to come by, and so some of those trends are I think impactful.
Right, and kind of to walk me through, because of these changes in environment, what are you doing differently? How is this year different than last year from a day-to-day operational perspective in that sense?
Yeah, I think for us, it's a little bit like folks in being smart about where we're investing our dollars. I think for us, we're looking beyond the current existing home sales environment and looking into an environment where things start to normalize, whether that's next year or 25 or kind of even late 25. And ensuring that we continue to drive that customer experience and scalability.
Right.
Because look, we never want to lose a customer, right? And so we want to make sure that not only are we building the right product suite, so as customers adapt, we can serve them across different markets and environments, but ensure that we can sustain that experience and continue to be competitive in our lending terms, right? And so those are the things that we are kind of investing in. A little bit more like infrastructure work, right? But ultimately, the reward is to ensure that customers can get that experience across a wider spectrum of products. And so those are the things that we are focused on.
Right. You can't change the market, so focus inside for a second and make sure that if and when things come back to a better normal, you're there to execute, better than you've ever done before, kind of thing, is the ethos.
Yeah, exactly. Yeah, and look, I think we're making smart investments to think through ways we can enhance, customers' experience and output even in this environment. As well as, I think maybe for your audience, right? I think it's one of the things that we haven't really historically invested in is more of the broker channel work and thinking through acquisition channels, and so those are things that we're looking into more now,
right, to
kind of expand our acquisition philosophy.
Yeah, and on the capital market side, so Kiavi is one of the original, if not the original, securitizers of loans and being a direct issuer in the securitization market, and so and in fact have stayed in the market, which is fascinating because most people have exited securitization or thought of securitization as a viable exit whatsoever in this kind of market. How are you still able to be in the securitization market and operate in there? I mean, when everyone else has kind of abandoned it from a bridge loan perspective.
Yeah, look, I would definitely say the current market is just okay, right? It's definitely, I wouldn't call it a great market, but for us, it's a really important pillar of how we think about our overall funding and capital strategy. And it's been important for us to continue to show like our investors how we're doing in this environment. I kind of consider securitizations as a very, I'll say, public way to share how you are doing as a company, how this asset class is doing in general. And I think a strong point of differentiation for us, as people can see the relative difference between Kiavi and the product we offer relative to other issuers in the market, right? And I think we have done a good job of being a consistent issuer, which is really important to the audience in that space, but also build kind of deeper relationships with institutional clients and really again, it's been an education process. And, I consider the extra 25, 50, 75 basis points that we're paying today in the securitization market an investment in the future, right? I think we'll continue to build trust there, and providing investors an asset class that they'll continue to support us in the future when pricing is different.
So that's interesting. So it's, in last year, securitization was solely a vehicle. This is the absolute cheapest cost to capital. That's why I'm using it. It's the only reason I'm going to use it. And so, at least from your average issuer's perspective, right? And so from your perspective is no, like I'm actually, we're intentionally not necessarily taking the cheapest cost of capital here for purposes of maintaining, kind of market dominance in the future, and otherwise really establishing that, no, we will continue to participate always and be kind of a leader within the space. That's fascinating to kind of have that sort of long game mentality, even in a very difficult market from a margins perspective, from an operating. And that leads me on to my next kind of big one, which is, as you and I have talked a good amount before, which was, there's rumblings of rated securitization. So for those that, on the call that are not aware, is, kind of up to this point, these short-term, RTLs or residential transition loans have all been done through unrated securitizations. You, I'm sure, know the numbers better than I do in terms of the number of participants who can participate in that sort of, or either can or will participate in an unrated securitization. And currently they are trying to get these sort of securitizations rated, which means that, any bond buyer can kind of participate. And so walk me through big picture, your thoughts on rated securitizations and how this will affect the private lending market first, and start there.
Yeah, sure. Look, I definitely think it's a positive technical, right? Just the fact that, we have a rating agency out there willing to put out ratings criteria for the product. I think it's a great technical, shows that people are paying attention to the space and see the potential for the space to continue to be an institutional asset class, which ultimately brings more capital, right? And capital means liquidity, which means more money flowing through to lenders to support investors and customers, right? When I see this market, it's still very much like I think 60% of the market is kind of cash or like kind of your country club money, right? And there's only about 35, 40% that's financed. And so it's an opportunity for that, capital to hopefully reach further or reach more customers. I do think, based on our experience as an issuer, there are a lot of folks in the market, to your point, that would love to get involved in the asset class once there's a rating attached to it. And so, look, I think ultimately it's a great liquidity option for the business. I think it's yet to be seen how things materialize from like an actual like bond sizing perspective and the math and the interest rates and all that stuff. But I think from a purely liquidity technical perspective, I think it's a big positive.
And walk me through. So this is interesting too. Is right now, if they do rated securitizations, there's going to be an expectation of certain underwriting requirements and kind of the way in which the issuer is going to be operating their business. Does we talked about that earlier in the call too, which is a big part of what you've been doing for most of your career, is bridging the gap between institutional capital and how a fix and flip or RTL lender actually originates a loan, and trying to get these two parties in line with each other so that they can produce safe assets and safe loans. So when you're reading through the rated securitization material, are the expectations in line with kind of how you operate and Kiavi operates, or is it still, hey, I think it's a little, you guys are kind of missing the mark of expectations here? What are your thoughts?
Look, I think it's early stages, right? I think this is the first cut. I think it's going to take some time, as again, the agency that's willing to rate the product as per the guidelines is coming at it from like a consumer non-QM angle first, but obviously adding the right overlays from a bridge loan perspective. And I think it's just an education process from our perspective. I think the benefit that we have as Kiavi, right? I think we're closing in on 70,000 units almost done. over the last like 7-8 years. And so we have a lot of information. And the beauty of the asset class is the loans pay off, right, in 6 months or 9 months. You don't have to wait like 2 years, 3 years, 30 years to actually have good performance data.
Right.
And so ultimately the proof is in what's in the performance, right? And so the benefit that we as Kiavi have is we have an operating model that's, driving customer experience and customer growth, but also driving investor expectations and investor returns. And I think we're able to kind of clearly work with them to kind of say, hey, here's kind of what we see as differences in the process, right? And kind of like, again, to my earlier point, view it as an educational opportunity. And I feel like the agencies also want to learn about the product, right? It's a new product from their perspective. And, we are also, I think the advice from our perspective, right, is also the fact that, we have our own data scientists, right? We haven't outsourced our data science team to the rating agencies. We've actually kind of built a robust framework around that and to bring that discipline. And so we can have very educated conversations with them around coefficients and risk factors and how we think about this scenario versus that scenario, right? Because I can tell you, as a lender in this space, and I'm sure like a lot of your clients here would tell you is, no same deal is this, there's no deal is the same as the next one, right? Things are very non-conforming, even from the same customer in the same market. And so, that's going to be something interesting to work through with the rating agencies, because it is very unlike the non-QM space or a consumer product.
And that was kind of the initial, on my flight out there, I was, Kevin and I were actually reading through the securitization paperwork together. And that was one of the things where we kept saying, it feels like they're really trying to create an omnibus, residential mortgage-backed security. And it might be a non-QM, it might be a fix and flip. And you're like, wait, hold on. Like foreclosure timelines, these sorts of things. And I was like, a fix and flip lender is not sitting on this asset for many, many months. They're not going to have a, 6 months before they do something about this transaction. It seemed a little bit of a disconnect about the operator, particularly as it related to treatment of delinquency and how, and the velocity of how a RTL originator would move when servicing these loans. If you were to just throw a dart on a wall and say, when do you think the possibility of the first rated securitization could occur? What do you think?
Look, I think there are a lot of, I'd say, issuers out there very incentivized to issue. Like to your point, I think liquidity in the unrated market is not there for every issuer today. And so I think given that dynamic, probably within the next 6 months will be my guess.
Yeah.
I think somebody would go to just test the pipes. Yeah.
And so, and from what today is, are you like, hey, look, I'm happy over here in my unrated world. Like if it comes along, great. And maybe we'll look into it further, or are you just super excited? What's your take from a Kiavi specific perspective?
Oh, look, no, I'm excited, right? I think it's a good opportunity. Again, it's going to be a learning curve and education and investment from my perspective. And look, I think we're totally looking forward to working with the rating agencies and again, sharing information so that ultimately it's important for us that investors, right, institutional investors have the right view on the product.
Right.
And being the leading lender in the space with the data, with the performance history, with the operating history, we're able to kind of provide that information in a very clean manner and translate that. And so we're looking at this as a partnership ultimately. And I think like that's how the rating agencies view it to my mind. So again, it's not going to happen tomorrow, but over the next, few months and quarters, I think you will continue to see iterations of this.
That's right. And then kind of just taking a look ahead, just prognosticating a little bit about the future, obviously, still very unclear, but from your seat, where do you kind of see, just general interest rate environment going, next 90 days or so? And what's your take?
Oh boy. I think next 90 days, I would say like if I had to pick a number, right, I'd probably just lean conservative and say probably like flat to higher.
Right. Right.
I think it's hard to make a very educated guess at this point, even which is what makes it very tough, right, in this environment.
Yeah. And then what about just kind of your general predictions? You're going into 2024, just kind of the RTL market in general and your view on it next year. What are you thinking?
Yeah, look, I think it's gonna be a function. I think going back to the rates conversation first, right? Look, my sense is things could remain expensive for a while. I think from what I've read, typically when the Fed cuts rates, it's because something's broken. and they
Right.
go big, not small. And so does that happen in Q2, Q3? I don't know.
Yeah.
And look, maybe there's a soft landing, right? And maybe there's this perfect environment, but is a soft landing, I would say, good for the mortgage market? It's hard to say, right? It does, because you could have structurally higher rates for a longer time, which would then require, I think, more sensitization to the current level of rates for housing velocity to recover. And so that's kind of a tail scenario, but that's definitely in the possibility.
Right. Yeah.
I
May
think,
not be the best scenario. Right. No, sorry, go ahead.
Yeah, look, I think from our perspective, we can expect a little bit more of the same that we're seeing in H2 of this year, right? I saw your chart, right? Like, I don't, we don't think that chart's going to continue to glide upwards and you're going to see a 60% increase over the next 9 months, right? I think, 5 to 10% would be a win. I think if mortgage rates stay here and housing velocity stays here.
Right.
And so, like, I think you have additional factors also happening, right? There are other like mortgage risk weighting rules and stuff coming down on banks, and who knows what that does to the consumer market and so forth, right? And so things are looking more expensive. And look, the housing market, I would say, disinflationary transition mechanism the Fed's typically looked at it is just not there right now.
Right. Right. They're trying to break the fever, and the tools aren't working to break the fever. Yeah, it's kind of fascinating to watch. How little it's affected affordability pricing and all the above, no matter how hard they're trying to do it. What is your Kiavi, or kind of thinking through the future? I mean, what are products, features, like what's new and upcoming for you?
Yeah, sure. Yeah, look, I think we're super excited right about the future. We still think the opportunity fundamentally from a housing market perspective, especially for the fixed and flip asset class and the real estate investment asset class as a whole, still holds, right? Housing demand kind of fundamentally is going to continue to remain. Supply technicals are going to remain relatively poor. And so from that perspective, I would say the underlying foundation is positive, as whether you're a fixed and flip investor or looking to get into real estate investing.
Right.
I think for us, it's really, as I mentioned earlier, right? Like, how do we continue to innovate on customer pain points and how we think about providing more opportunity sets for our customers to continue to grow with us.
Right.
And part of that is pushing more certainty faster in our funnel so that, folks can get instant feedback on what their deals look like and how they qualify and what the loan terms are, so they can be better equipped to make those decisions, and ensuring that we can kind of pull through as a lender on the capital side and the time to close side. Second, I think it's really, product set wise, continue to think through offerings. We just rolled out an infill offering that will look to scale on the infill construction side over 2024, as well as we're looking at opportunities in the small multifamily side.
Right.
And then again, from an acquisition perspective, historically, we haven't been a huge broker channel acquisition player, but we've kind of doubled that over the last 18 months, and we're looking at opportunities there, whether it's through like a white label experience or table funding experience, on how we can think through.
Yeah, and that's actually probably a good. I was gonna say that's probably a good opportunity too, particularly for the audience here as well. I mean, I'm sure those are music to their ears as well, which is, can you get access to your ability to execute with your money, better yet. And so
right.
When do you anticipate having kind of white label or table funded type of models kind of being?
Look at some opportunities, as early as like the next 6 to 9 months, right? And so we're in active conversations, talking to some of our existing partners in the broker side and thinking through, okay, what makes sense, right? What do you really want out of this product that will allow you to scale and kind of build your business? And so I think we're kind of in the information gathering, understanding space. We kind of know the products that exist in the market today.
Right.
But again, I think we're trying to be a little bit more differentiated and make sure we can deliver on the differentiation.
Right. That makes a ton of sense. And just going quickly in the Q&A box, I know we're running, so we'll be out of time here momentarily. And Arvind, thank you so much for giving your time away here as well.
Yeah.
One of the questions that I saw earlier in the Q&A box is, for the average interest rate and loan amount data that was previously provided, is there data on the underlying LTVs that was based off? It is not. It's not something that I actually capture within the Lightning Doc system. So, one more aspect of you may have very high LTV loans, you may have very low LTV loans. Those are all being bundled up there together. Another question that I commonly get is that, what about points? I don't have points in there currently. That'll be, we'll be at AAPL in a couple of weeks. We're working on getting the points presentation as well, and seeing if there's any notable trends on points being charged, as well as other random things too. I have random questions I asked our data scientists, and I was like, why don't you just track underwriting fees? Like, is there any consistency in underwriting fees and processing fees and doc fees? Like, what is the fee structure, and are people trying to manipulate that over time in order to try to get some semblance of margin back into their business, just because so much of the back end compensation is all kind of been stripped for now. So interesting to find out how that exists, and I think we'll continue to try to strive. Last, I'll leave with you, Arvind. Any kind of parting thoughts you'd like for our audience here about how to work with Kiavi or otherwise with your business?
Yeah, look, like I said, right, I think, as we look at the future, right, we're super excited to support real estate investors, and, we're investing to think through, like, how do we do that better every day? And I think we want brokers to be a bigger part of our community over time. And, that's something that we're going to make active efforts in 2024 in thinking through offering the right kind of solution. Right. And look, we've always been reliable, right? As I mentioned, right, we lent through COVID, and we've been a consistent lender through the cycle here. And, we just want to bring that to a broader audience.
Makes a ton of sense. Well, Arvind, appreciate your time. Thank you, AAPL, for letting us host this event as well. And looking forward to seeing everyone at the AAPL conference in a couple of weeks here. Take care, everyone. Hope you have a great rest of the week.
All right. Thank you.